Dhandho Investor by Mohnish Pabrai. It's a wonderful book. I will highly recommend to listen all the lectures which Mohnish Pabrai delivered on YouTube. I will assure you of two things. You would take a quick pass on most investments offered to you. And starting with little capital, after a few decades, you will be very wealthy. The magic words in Dhandho, it was a classic. Heads, I win. Tails, I don't lose much kind of bet. We see change as the enemy of investments. So we look for the absence of change. We don't like to lose money. Capitalism is pretty brutal. We look for mundane products that everyone needs. Warren Buffett. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. Dhandho investors have concentrated their capital and their bets. Most of the time, they either do nothing or place very small bets. Every once in a while, they encounter overwhelming odds in their favor. At such times, they act decisively and place a large bet. Here is the framework for Dhandho investor. Invest in existing business. Invest in simple business. Invest in distressed business. Invest in business with durable moats. Few bets, big bets. Margin of safety always. Invest in low risk. Invest in the copycats rather than the innovators. Stock prices move around quite a bit, more than the movement in underlying intrinsic value. Human psychology affects the buying and selling of fraction of business on the stock market much more than the buying and selling of entire business. Markets aren't fully efficient because humans control its auction-driven pricing mechanism. Humans are subject to vacillating between extreme fear and extreme greed. When humans as a group are extremely fearful, the pricing of the underlying assets are likely to fall below intrinsic value. Extreme greed is likely to lead to exorbitant pricing. Of the 50 most important stocks on the NYSE in 1911, today only one, General Electric, remains in business. That's how powerful force of competitive destruction are. Over the long term, history shows that the chances of any business surviving in a manner agreeable to a company's owners are slim at best. Some moats are more durable than others. Wells Fargo and American Express were founded over 150 years ago, and amazingly, both their moats are as robust as ever today. Amazingly, as an aside, both American Express and Wells Fargo were founded by the same person, Henry Wells. The wise ones bet heavily when the world offers them that opportunity. They big bet when they have the odds, and the rest of the time they don't. It is just that simple. To be a good capital allocator, you have to think probabilistically. The most obvious business model entirely based on over probabilities in a casino. In investing, there is no such thing as sure bet. Even the most blue chip business on the planet has a probability of not being in business tomorrow. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Buffett and Munger have always fixated on a large margin of safety and gone to great lengths to seek out low risk, high return bets. It is truly fortune's formula. Ray Kroc and Bill Gates are the great business successes of our era. and shameless litters of other people's great ideas. Sam Walton was lifelong student of other retailers' model. Most of Wall Street business model was lifted from Kmart. In seeking to make investment in the public equity market, ignore the innovators. Always seek out businesses run by people who have demonstrated their ability to repeatedly lift and scale. It is a Dhandho way. The key to being a successful investor is to buy assets consistently below what they are worth.